today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Bitcoin is the only asset that can drop 12% while still being described as surprisingly stable. The euro was designed for unity, which is adorable given how often Europe disagrees on lunch. The dollar's superpower is convincing the world's problems to look smaller next to it. The market discounts everything except human optimism. We're trying to maximize returns and minimize risks, unlike everyone else, who are just dying to set their money ablaze.
Bitcoin just had a Black Friday sale that nobody wanted. The ETF outflows in November looked like investors printing out for a fire drill. Except that the building wasn't on fire, only their conviction was. This chart shows the tourist class of Bitcoin investors, the short-term thrill seekers, dumping positions the moment price momentum cooled. Meanwhile, the long-term holders are sitting tight, probably wondering why everyone else panicked over a routine crypto mood swing. The exodus doesn't mean Bitcoin is broken, it just means that the top of the investor pyramid is still built out of guests and not homeowners. Germany's GDP chart reads like a decade-long mood swing, the early 2000s slump, a GFC nosedive, a COVID wipeout, and now finally a slow crawl back into positive territory. The IMF is applauding Berlin's new fiscal flexibility, but here's the real issue. Spending more without fixing the engine won't get the economy cruising. Germany doesn't need a VAT cut on schnitzels. It needs lower labor costs, higher investment, and actual reforms that move the productivity needle. Right now, it's like tuning a car by polishing the headlights. Eli Lilly just became the world's first trillion-dollar drug maker, thanks to weight loss drugs so popular that they're practically a lifestyle brand now. With that jump, the global trillion-dollar club now has 12 members, basically the corporate equivalent of an exclusive Soho house. Nvidia, Apple, Alphabet, Microsoft, the usual tech high rollers, are still dominating the list. But Lilly's entrance is a reminder that in today's market, the hottest commodity isn't just AI. It's losing 5 kilos before your school reunion. Nvidia may be the world's most valuable company, but even $120 billion in annualized profit does not buy peace of mind. Their rebuttal to short sellers wasn't insecurity, it was a strategy. Nvidia's 75% margins relies on customers who are still burning cash, and those customers rely on investors who can vanish faster than AI hype on a bad earnings day. Add OpenAI's manifestly ridiculous $1.5 trillion compute tab, and suddenly everyone's asking, where does the money actually land in AI? The MRI example says it all. $150 for a doctor versus 15 cents for a model, a 99.9% cost collapse. But who captures the spread? The chip maker, the model maker, or the app layer? Even Nvidia isn't sure. Now enter Google, the low-cost zealot. Their plan is simple: drive costs down across the stack and win no matter where the economics settle. Nvidia wants to preserve luxury margins. Google wants to make AI so cheap that it becomes a commodity. India's IPO market is sizzling again, with 8 companies lining up to raise over 30,000 crores by end of December. From ICICI Prudential AMC's massive 10,000 crore issue to Meesho, Fractal Analytics, and even Milky Mist. The pipeline looks like a buffet of every sector imaginable. And what's driving this? Simple: strong liquidity, relentless retail appetite, and a market that's been hitting all-time highs like it's a daily hobby. Companies are rushing to cash in before the window narrows. As the old market joke goes, when the ducks are quacking, you feed them. And right now, Indian investors are quacking quite loudly. India's NRI deposits are hitting the brakes. Fresh inflows fell 40% in the first half of FY26, and the once booming FCNRB bucket crashed a massive 87%. The culprit is simple: the India-US rate gap has narrowed, so the EC interest rate arbitrage that NRIs loved has basically evaporated. So what's happening instead? A lot of expats seem to be parking money in equities and not deposits. When markets are at record highs and returns trouncing fixed income, it's hard to blame them. India's public sector heavyweights are having a moment. LIC towers above the pack at 6 lakh crores. followed by ONGC, SBI, NTPC, Coal India, HAL, and others. A lineup that looks less like the stodgy state enterprises and more like a power portfolio running the country's core infrastructure. What's driving this resurgence? Clean balance sheets, capex heavy budgets, and a market suddenly realizing that these PSUs aren't the slow movers that they used to be. HAL is flying high, BHEL is back in demand, and ONGC is minting cash. And IOC continues to be India's energy backbone. The Adani Group's scale in 2025 is, enormous. Ports, power, renewables, cement, gas, transmission, media. The group now spans virtually every essential sector. Adani Ports leads the pack at 3.22 lakh crores, closely followed by Adani Enterprises and Adani Power, each brushing the 3 trillion rupees mark. Ambuja and ACC reinforce the cement footprint, and Adani Renewables pushes the green push. And even NDTV sits in the corner as a media outpost. It's less a conglomerate and more a map of India's infra backbone. And by the way, the total market cap of these 9 companies together is 1,470 lakh crores.